Today's topic explains how mathematical models guide central banks in setting interest rates, shaping inflation, control stability, and economic decision making. Mathematical models drive central bank interest rate decision. Imagine a policy decision that can raise mortgage payments for millions of households, move global stock markets within minutes, shift exchange rates across continents and alter the trajectory of entire economies, all with a change of just 0.25 percentage points. That is the power of central bank interest rate decisions. Interest rates are the most influential level of modern macroeconomic policy. They shape inflation, employment, investment, asset prices, government debt, sustainability, and financial stability. Because the stakes are so high, central banks cannot rely on instinct, political pressure, or anecdotal evidence alone. Instead, they rely deeply and systematically on mathematical and statistical models. While interest rate decisions are formally made by committees of human policymakers, those decisions are framed, constrained, and informed by models. At institutions such as the Federal Reserve, the European Central Bank, and the Bank of England, models from the backbone of monetary policy analysis. Today's lecture explores how mathematical models drive central bank interest rate decisions. We will examine why models are necessary, the main types of models used, how they shape inflation analysis and financial stability concerns, how they influence communication, and why judgment remains indispensable despite sophisticated mathematics. The rationale for model-based monetary policy. Central banking operates in an environment defined by uncertainty, complexity, and delayed feedback. When a central bank changes interest rates today, the full effects on inflation and economic activity may not appear for 12 to 24 months. Policymakers must therefore act based on forecasts rather than observable outcomes. Mathematical models are for essential purposes. First one, consistency. Models impose logical discipline, assumptions about household behavior, firm pricing, labor markets, and financial conditions must fit together in a coherent framework. This reduces the risk of internally contradictory policy reasoning. Second one, forecasting. Models allow central banks to project inflation, output, employment, and financial conditions under different interest rate paths. Without such projections, policy would be reactive rather than forward-looking. Third one, scenario analysis. Models enable policymakers to simulate shocks, oil price spikes, financial crisis, pandemics, or geopolitical disruptions, and evaluate how different interest rate responses might stabilize the economy. Fourth one is communication. Quantitative models help central banks explain decisions to markets and the public. Forecast charts, fan diagrams, and published projections all originate in model outputs. Without models, interest rate decisions would depend far more heavily on intuition and political pressure. Models do not eliminate judgment, but they anchor judgment in structured analysis. Financial stability and macro-financial models. The global financial crisis of 2008 exposed major weakness in pre-crisis models. Many failed to account for leverage, financial fragility, and non-linear dynamics. In response, central banks expanded their modeling frameworks to include financial frictions. Modern macro-financial models how incorporate credit cycles and leverage, asset price bubbles, bank balance sheets, risk-taking behavior under low interest rates. These models recognize that small stocks can trigger large economic disruptions when financial systems are fragile. As a result, interest rate decisions increasingly consider not only inflation and employment but also financial stability risk. For example, even if inflation is low, a central bank may hesitate to cut rates if doing so could fuel excessive borrowing or asset price inflation. Models help policymakers assess these trade-offs systematically. Despite their sophistication, mathematical models are imperfect representations of reality. They rely on assumptions that may not hold during structural change. Unprecedented shocks or behavioral shifts. The COVID-19 pandemic provided a dramatic example. Historical data offered little guidance and standard models struggled to capture sudden shutdowns and rapid reopenings. Central banks responded by combining model-based analysis with real-time indicators and qualitative information. This experience reinforced the importance in model pluralism, using many models rather than one and of human judgment. Policymakers must interpret model outputs critically, especially when different frameworks point in different directions. Mathematical models also shape how central banks communicate interest rate decisions. Published forecasts, fan charts, and policies scenarios all originate from models. Transparency enhances credibility by demonstrating that decisions are based on systematic analysis rather than political considerations. At the same time, central banks must communicate uncertainty honestly. Forecasts are conditional, not promises. Clear communication helps anchor expectations, making interest rate policy more effective. When markets understand the logic behind decisions, policy transmission improves. Critics argue that heavy reliance on models can lead to technocratic overconfidence and blind spots. Models may underrepresent inequality, climate risk, or distributional effects of interest rate changes. There are also concerns about accountability. If decisions are justified by complex models, it can be difficult for the public to challenge or fully understand policy choices. Central banks must therefore ensure that model-based decisions remain subject to democratic oversight and clear explanation. Mathematical models are indispensable tools in modern central banking. They structure how policymakers interpret data, forecast the future, evaluate interest rate decisions, and communications with the public. From simple rules like the Taylor rule to complex structural and statistical frameworks, mathematical underpins nearly every stage of the monetary policy process. Models do not replace human judgment. Interest rate decisions emerge from an interactive between quantitative analysis, institutional experience, depend and evolving economic realities. The most effective central banks understand both the power and the limitations of models. They use them as guides, not masters, and anchoring policy in systematic analysis while remaining alert to uncertainty and change. As economics grow more complex and interconnected, the role of mathematical models in shaping interest rate decisions will only expand. Ensuring that these models remain robust, transparent, and responsive to the real world will be one of the defining challenges of monetary policy in the years ahead.